Welcome to our comprehensive guide on financial management. In today's fast-paced world, understanding how to manage finances is crucial for both individuals and organizations. This video will walk you through the essential aspects of financial planning, investment management, financing, risk management, profitability, and liquidity. By mastering these concepts, you'll be better equipped to make informed decisions, achieve your financial goals, and ensure long-term stability. Let's begin our journey by exploring the foundation of financial management, financial planning. Financial planning is the cornerstone of effective money management. It involves setting clear financial goals, creating budgets, and forecasting future outcomes. Whether you're managing personal finances or running a business, a solid plan helps allocate resources wisely and prepares you for unexpected challenges. By understanding where your money is going and what you want to achieve, you can make smarter decisions and stay on track toward your objective. Next, let's dive deeper into the budgeting process. Budgeting is about allocating resources to achieve your goals. There are two main types: operating budgets and capital budgets. Operating budgets focus on day-to-day expenses, ensuring you have enough to cover routine costs like salaries, utilities, and supplies. Capital budgets, on the other hand, are for long-term investments such as new equipment or expansion projects. By distinguishing between these two, you can better manage both immediate needs and future growth. Now, let's look at how forecasting plays a role in financial planning. Forecasting is the process of predicting financial outcomes based on current data and trends. It helps you anticipate future sales, expenses, and cash flows, allowing for proactive decision-making. Sales forecasting estimates future revenue, while expense forecasting projects upcoming costs. Accurate forecasts are vital for setting realistic goals and preparing for potential challenges. With reliable data, you can adjust your strategies to stay ahead. Next, we'll discuss how to set effective financial goals. Goal setting is a critical part of financial planning. It involves defining both short-term and long-term objectives, such as increasing profits, expanding operations, or saving for retirement. Key metrics like return on investment (ROI) and payback period help measure progress and success. By setting clear, measurable goals, you create a roadmap for your financial journey and can track your achievements over time. Let's move on to investment management and see how your money can work for you. Investment management is about making your money grow. It involves choosing where to invest, such as stocks, bonds, or alternative assets, and balancing risk with potential returns. A well-managed investment portfolio can help you achieve financial goals faster and build wealth over time. Understanding the basics of asset allocation and risk-return analysis is key to making informed investment decisions. Next, let's explore the concept of asset allocation in more detail. Asset allocation is the process of spreading your investments across different asset classes, such as equities, debt, and alternatives. Equity investments include stocks, which offer growth potential but come with higher risk. Debt investments like bonds provide steady income with lower risk. Alternative investments can include real estate or commodities. By diversifying your assets, you can reduce risk and improve the chances of achieving your financial goal. Now let's look at how to balance risk and return. Risk-return analysis is about finding the right balance between the risk you're willing to take and the returns you expect. Every investment carries some degree of risk, but higher risks often come with the potential for higher returns. Assessing your risk tolerance and setting realistic return expectations are crucial steps in building a successful investment strategy. Let's see how portfolio management ties all these elements together. Portfolio management is the art of managing your investments to achieve your financial objectives. It involves diversification, spreading investments to reduce risk, and rebalancing, which means adjusting your portfolio as market conditions change. Effective portfolio management helps you stay aligned with your goals and adapt to new opportunities or risks. Next, let's shift our focus to financing and how organizations raise and manage capital. Financing is all about raising the money needed to fund operations or growth. Organizations can choose between debt financing, such as loans and bonds, or equity financing, like issuing shares or attracting venture capital. Each method has its pros and cons, and the right choice depends on your goals and risk tolerance. Managing the cost of capital is also essential to ensure that financing remains affordable. Let's break down the types of financing in more detail. Debt financing involves borrowing money that must be repaid over time, usually with interest. Common forms include bank loans and bonds. While debt allows you to retain ownership, it also creates an obligation to make regular payments. Managing debt responsibly is crucial to avoid financial strain and maintain a healthy balance sheet. Next, let's look at equity financing and how it differs from debt. Equity financing means raising capital by selling shares of your company. This approach brings in investors who become part owners and may share in profits through dividends. While you don't have to repay equity like a loan, you do share control in future earnings. Equity financing is often used for startups or businesses seeking rapid growth. Now, let's discuss the cost of capital and why it matters. Cost of capital is the price you pay to raise funds, whether through debt or equity. For debt, it's the interest rate on loans or bonds. For equity, it's the dividends paid to shareholders. Managing these costs is essential to maximize profitability and ensure that financing decisions support long-term growth. Let's move on to capital structure and how organizations balance debt and equity. Capital structure refers to the mix of debt and equity used to finance an organization. Finding the optimal balance is key to minimizing costs and maximizing value. Too much debt increases risk, while too much equity can dilute ownership. The right mix depends on factors like industry, market conditions, and company goals. Next, let's explore risk management and how to protect your finances. Risk management is about identifying, assessing, and mitigating potential threats to your finances. Every organization faces risks, whether from market changes, credit issues, or operational failures. By understanding these risks, you can develop strategies to protect your assets and ensure long-term stability. Let's start by identifying the main types of financial risks. Financial risks come in many forms. Market risk involves changes in interest rates or currency values that can impact your investments. Credit risk is the possibility that borrowers may default on their obligation. Operational risk arises from internal process failures or external events. Identifying these risks early allows you to take proactive steps to minimize their impact. Next, let's discuss how to mitigate these risks. Mitigating risk involves using strategies like insurance, hedging, and diversification. Insurance provides financial protection against specific losses. Hedging uses financial instruments to offset potential losses from market fluctuations. Diversification spreads investments across different assets to reduce overall risk. By combining these techniques, you can safeguard your finances and maintain stability even in uncertain times. Now, let's turn our attention to profitability. Profitability is the ultimate goal of any business. It's about generating more income than expenses and ensuring long-term sustainability. Effective revenue management, cost control, and profit analysis are key to maximizing profits. By regularly reviewing your financial performance, you can identify areas for improvement and make strategic adjustments. Let's start by looking at revenue management. Revenue management focuses on maximizing income through effective pricing strategies and accurate sales forecasting. By understanding market demand and customer behavior, you can set prices that optimize revenue. Sales forecasting helps predict future income, allowing for better planning and resource allocation. Together, these tools help ensure a steady flow of revenue. Next, let's discuss cost management and how to control expenses. Cost management is about controlling expenses to improve profitability. Costs can be fixed, like rent and salaries, or variable, such as materials and utilities. By monitoring and managing both types, you can identify savings opportunities and avoid unnecessary spending. Effective cost management ensures that more of your revenue turns into profit. Now, let's analyze profitability using key financial metrics. Profit analysis involves examining your financial statements to understand how much profit you're making and why. Margin analysis looks at the difference between revenue and costs, while break-even analysis determines the sales needed to cover expenses. These tools help you make informed decisions about pricing, cost control, and growth strategies. Next, let's explore liquidity and why it's vital for financial health. Liquidity refers to how easily you can access cash to meet short-term obligations. It's a key indicator of financial health for both individuals and organizations. Managing liquidity ensures you have enough funds to cover expenses, invest in opportunities, and weather unexpected challenges. Let's start by looking at cash management and its role in maintaining liquidity. Cash management involves monitoring and optimizing cash flow to ensure you always have enough on hand. This includes forecasting future cash needs, managing receipts and payments, and investing surplus cash wisely. Effective cash management helps avoid shortages, reduce borrowing costs, and take advantage of investment opportunities. Next, let's discuss working capital and its components. Working capital is the difference between current assets and current liabilities. Managing it involves balancing accounts receivable, accounts payable, and inventory. Efficient working capital management ensures you can meet short-term obligations and invest in growth. By keeping a close eye on these components, you can maintain financial flexibility and avoid cash crunches. Now, let's summarize what we've learned so far. We've covered the essentials of financial management, from planning and investment to financing, risk management, profitability, and liquidity. Each area plays a vital role in achieving financial stability and growth. By applying these principles, you can make better decisions, optimize resources, and build a strong financial foundation. Next, let's look at some practical examples to see these concepts in action. Imagine a small business planning its annual budget. The owner starts by estimating sales and expenses, then allocates funds for daily operations and future investments. By tracking actual results against the budget, adjustments can be made to stay on course. This practical approach helps ensure resources are used efficiently and goals are met. Next, let's see how investment management works in practice. A young professional decides to invest her savings. She diversifies her portfolio by buying stocks, bonds, and real estate. By regularly reviewing her investments and rebalancing as needed, she manages risk and works toward her financial goals. This example shows how investment management can help individuals grow wealth over time. Now, let's look at a financing scenario. Startup needs funds to launch a new product. The founders consider both debt and equity financing. After weighing the pros and cons, they decide to take out a loan for initial costs and seek investors for future growth. By managing the cost of capital and maintaining a balanced capital structure, the startup positions itself for success. Next, let's see how risk management is applied. Manufacturing company faces risks from market fluctuations and supply chain disruptions. To mitigate these, it purchases insurance, uses hedging strategies, and diversifies suppliers. These actions help protect profits and ensure business continuity. This example highlights the importance of proactive risk management in safeguarding financial health. Now, let's look at profitability in action. Retail store reviews its pricing strategy and cost structure. By adjusting prices and negotiating better deals with suppliers, the store increases its profit margins. Regular profit analysis helps identify what's working and where improvements are needed. This approach ensures the business remains competitive and profitable. Next, let's see how liquidity is managed in practice. Company monitors its cash flow daily to ensure it can pay suppliers and employees on time. By forecasting cash needs and managing receivables and payables, the company avoids cash shortages and maintains smooth operations. Effective liquidity management is essential for meeting obligations and seizing new opportunities. Now, let's discuss some common challenges in financial management. Financial management isn't without its challenges. Common issues include inaccurate forecasting, unexpected expenses, and difficulty accessing capital. Market volatility and regulatory changes can also impact financial plans. By staying informed and flexible, you can adapt to these challenges and keep your finances on track. Next, let's look at some tips for effective financial management. Manage finances effectively. Start by setting clear goals and creating detailed budgets. Regularly review your financial performance and adjust your strategies as needed. Stay informed about market trends and seek professional advice when necessary. Embrace technology to streamline processes and improve accuracy. These tips can help you build a strong financial foundation and achieve lasting success. Now, let's explore some key financial management concepts. Return on investment, or ROI, measures the profitability of an investment. It's calculated by dividing the net profit by the initial investment cost. A higher ROI means better returns relative to the amount invested. This metric helps compare different investment opportunities and make informed decisions. Next, let's define the payback period and its significance. Payback period is the time it takes to recover the initial investment from the cash flows generated by the investment. A shorter payback period is generally preferred, as it means you get your money back faster. This concept is useful for evaluating the risk and attractiveness of different projects. Now, let's look at asset allocation as a core investment concept. Asset allocation is the process of dividing investments among different asset categories, such as stocks, bonds, and real estate. The goal is to balance risk and reward according to your financial goals and risk tolerance. Proper asset allocation can improve returns and reduce overall risk. Next, let's define diversification and its role in portfolio management. Diversification means spreading your investments across different assets to reduce risk. By not putting all your eggs in one basket, you can protect your portfolio from significant losses if one investment performs poorly. Diversification is a fundamental principle of sound investment management. Now, let's define capital structure and its importance. Capital structure refers to the way a company finances its operations and growth through a combination of debt and equity. The optimal capital structure minimizes the cost of capital and maximizes value for shareholders. Understanding capital structure helps organizations make better financing decisions. Next, let's define working capital and its role in liquidity management. Working capital is the difference between a company's current assets and current liabilities. It measures the organization's ability to meet short-term obligations and fund day-to-day operations. Positive working capital indicates good financial health, while negative working capital can signal potential liquidity problems. Now, let's define margin analysis and its use in profitability. Margin analysis examines the difference between revenue and costs expressed as a percentage of sales. It helps businesses understand how much profit they make on each sale and identify areas for improvement. Higher margins mean more profit per dollar of sales. This analysis is crucial for pricing and cost management decisions. Next, let's define break-even analysis. Break-even analysis determines the sales volume needed to cover all costs with no profit or loss. It's a valuable tool for setting sales targets and making pricing decisions. Knowing your break-even point helps you plan for profitability and manage risks. Now, let's define hedging and its role in risk management. Hedging is a risk management strategy that uses financial instruments to offset potential losses from market fluctuations. Common hedging tools include options and futures contracts. By hedging, organizations can protect themselves against adverse price movements and reduce uncertainty. Next, let's define insurance coverage in financial management. Insurance coverage provides financial protection against specific risks such as property damage or liability claims. By transferring risk to an insurer, organizations can safeguard their assets and ensure business continuity. Insurance is a key component of a comprehensive risk management strategy. Now, let's define cash flow forecasting. Cash flow forecasting estimates the amount of cash that will be available over a specific period. It helps organizations plan for expenses, avoid shortages, and make informed investment decisions. Accurate cash flow forecasts are essential for maintaining liquidity and financial stability. Finally, let's wrap up with a summary of financial management best practices. To excel in financial management, focus on planning, monitoring, and adapting. Set clear goals, create detailed budgets, and regularly review your financial performance. Diversify investments, manage risks proactively, and maintain sufficient liquidity. Embrace technology and seek expert advice when needed. By following these best practices, you can achieve financial stability, support growth, and secure a prosperous future.